It's Brian Preston, the Money Guy.
We are going to start with Ben's question. He says, is allocating a portion of my investing into single stocks of big companies like Berkshire, Google, Pepsi, etc., is this a good strategy during a bear market? Many of those stocks have been outperforming the S&P. What do you guys think?
Great question. So let's talk about let me talk about our general guidance, and we'll talk about what's unique right now. Individual stock investing is, a lot of people have made huge careers doing that, right? You hear people who've had success doing that. The problem is it's kind of difficult to really diversify well if you're having to pick individual stocks, because you have to have a lot of individual stocks to go out there and get diversification. Whereas it's much easier to say, hey, you know what? I believe in the future production of America, and I think that large companies will continue to do well in this country. So rather than having to go have 500 different holdings, I can just go buy the S&P 500. That's kind of where we land. We love low-cost index funds where you can get broad-based diversified exposure. But some people say, hey, I like stocks. I like the idea of owning a specific company, or I like supporting a specific company. And traditionally, our recommendation is if you're going to hold individual stocks, or maybe you work for a company where part of your compensation comes through publicly traded securities, we'd like for you to keep the exposure across your total portfolio around 5 to 10% of your total portfolio so that you don't have over concentration risk. Now, Brian, with that, does current economic circumstance change that guidance, or how does that factor in?
Well, I think it's interesting. I have two big thoughts just popped in my brain. Bo and I were in a car yesterday for 5 hours because we had a 401k presentation in the morning, and then we had to drive back. It was great. I mean, we had 200 plus people in a room. They were so excited. The company we work with, they do a great job of getting everybody all hyped up. They were throwing out peaches with $20 bills attached to it. It was just fascinating. But when we were talking about it, Bo and I, this is how nerdy we are. If you want to know, what do Brian and Bo do on a road trip where they're in the car 5 hours?
This is going to make us sound like such
losers. We're yelling out companies, big companies, to look at their price to earnings ratio currently and their dividend yield. Because, I mean, it's just, it is fascinating right now. And I've told people that here's where where you are in this bear market. And I'm not calling a bottom because we don't know, because there's a lot of emotional stuff that kicks in. But there will come a point, and this is why when people don't believe that you can make 15% in a month, I'm always like, there has to come a point where the market value of the markets is not connected to the intrinsic value of the companies, because emotionally people just start throwing away good stuff. Yep. You just see it every time we go through a bear market. You see the disconnect. That's when the whole Warren Buffett, be fearful when others are greedy and greedy when others are fearful. That's where it comes in. So Bo and I, we're trying to take a measurement of how crazy things are right now. And there are a few individual stocks that you go look at and you go, whoa, the price to earnings ratio on that is like 4, and the dividend yield is getting close to 6. You're like, whoa, what do people think is going to happen there? But here's Ben. I don't want you to get distracted. This was entertaining for us, but I'm trying to make sure when we do the Money Guy show, we're helping you have the best opportunity to kind of navigate to maximize every dollar that you are fortunate enough to manage and ensure that it is turned into the best version of itself. And that's why we did develop brand new, rebranded right off the presses, but we've had the financial order of operations, which is the 9 steps, the 9 proven steps to help make sure you maximize how you do that with every dollar that you come into. And we love index funds because they allow you're fishing with nets versus fishing with a fishing pole. Look, it's fun to be a sport fisherman in light of all the scandals that have been in sport fishing recently that has wasted 15 minutes of content meetings. But sport fishing is fun. But more often than not, you only share your big winners. You don't tell everybody all your fishing tales of how you sat in a boat and it didn't work out well. I would rather, since your retirement, your family, and your future depends upon it, let's fish like your life really does depend upon it, like you're a commercial fisherman. Throw the nets in the water. That's going to happen with index funds. So that's why I want you all the way through step 8, 1 through 8, all the way to 8, I guess 1 through 7. I want you focusing on making sure you're maximize your savings rate, your investment rate, that you're taking advantage of all the tax-free growth opportunities, the free money from your employer. All of that should be done with your eating money.
That's right.
That's what steps 1 through 7 are, is to make sure you have the best version of yourself in retirement, and your future self gives you that sloppy bear hug where you can't believe how successful you are. But I think once you're saving and investing 25% and you've made it through steps 1 through 7 and you reach step 8 and you're trying to figure out, am I doing, residential real estate? Am I doing individual stocks? Am I buying a nicer car because I've made it through some of those basics and the foundational things? Ben, I don't have a problem with it. Just I do want to warn you emotionally. I struggle with people who they will have a net worth of $2 million but have $25,000 in one individual stock, and that one stock will depress them when it's up or down. And I just don't make sure that you don't get so emotionally connected that at Thanksgiving you're not only setting a table for your aunts, uncles, nieces, and nephews, that you're also setting a table for that individual stock that you're emotionally connected to. That's not healthy. So just make sure you keep those things, do it at the right time. This is vacation money, not eating money, as Charles likes to share with us. Just make sure you're putting that in the right order, and I think you'll be served well.
Love it.